So, um, how does a geopolitical conflict that, traps like 10% of global shipping vessels actually lead to a company having its second best quarter in history?
Right, and without selling a single new product either.
Exactly. I mean, it sounds like a math problem with a completely broken equation.
It really is.
Because, we look around our homes, we see the laptop, the coffee maker, the car in the driveway, and we just sort of assume the global supply chain that delivered them is this, like, smooth, indestructible machine.
Right, a perfectly oiled machine.
Yeah. But when you look at the raw data, you realize that volatility isn't just a disruption to that machine. For the people who actually own the underlying infrastructure, volatility is, well, it's incredibly profitable.
It is. That is the operational reality of global trade.
Yeah.
And we're examining a very specific snapshot of that reality today. So we're looking at the official Q1 2026 financial and operating results. That's both the presentation deck and the press release from Imperial Petroleum, Inc. And this is dated May 22, 2026. These documents, I mean, they basically offer a masterclass in how massive geopolitical shocks translate directly into cold, hard corporate financials.
Right. And so our mission for today's deep dive is to kind of pull back the curtain on this often invisible world of maritime logistics.
Exactly.
Because for most of you listening, a conflict breaking out on the other side of the world, it's a news headline, it's something you monitor on your phone.
Yeah, it feels very distant.
But for the shipping industry, it fundamentally alters the physics of global trade. So we are going to explore the mechanics of how chaos creates profit. Okay, let's unpack this.
Well, to really understand the sheer scale of the windfall here, we have to look at the raw financials from this first quarter.
Bring on the numbers.
So Imperial Petroleum reported revenues of $61.7 million.
Wow. Okay.
Yeah, and to put that into perspective, that is a 92% increase compared to the first quarter of 2025.
Wait, 92%.
Literally almost doubled. They essentially doubled their top line in 12 months.
I mean, almost doubling revenue in a mature, capital-heavy industry like shipping is staggering.
Yeah.
That's the kind of growth curve you expect from like a tech startup.
Right, not a fleet of massive steel vessels.
Yeah. So what about the bottom line?
The bottom line is even more indicative of what the market conditions were like. Their net income came in at $28.0 million,
Okay.
which is up 148% from Q1 of the previous year.
That is wild. 148%.
Yeah, and that translates to an earnings per share of 60 cents. But the really interesting metric here, and if we look at their EBITDA...
Which is earnings before interest, taxes, depreciation, and amortization. Right?
Exactly. Their EBITDA reached $34.4 million.
Okay.
And in the shipping sector, EBITDA is a crucial metric because it strips out the heavy depreciation costs of the physical ships.
Oh, because ships naturally lose value over time.
Right, they depreciate heavily. So EBITDA gives you a very clear picture of their raw operational cash flow.
So the cash flow is just massive. But, I mean, a company like this doesn't just have one boat moving back and forth. Right?
And not at all.
To capture that kind of upside, their operational structure has to be highly deliberate. So how are they actually set up on the water?
Well, they operate a deliberately diverse fleet. The sources indicate they currently have 21 vessels on the water.
Okay, 21.
Yeah, and this includes dry bulk carriers, product tankers, and crude oil tankers. And they aren't just sitting idle.
Right.
They reported a fleet operational utilization rate of 88.7% for the quarter.
That's practically running at full tilt. But before we get deeper into their strategy, the sources specifically mention they operate two quote-unquote Suezmax tankers.
Ah, yes, the Suezmaxes.
Yeah, I know we see photos of these massive ships in the news, but what exactly does that term mean in a logistical sense?
It's actually a very literal term in maritime engineering.
Okay.
A Suezmax is the absolute maximum size of a ship capable of transiting the Suez Canal fully loaded.
Oh, I see. So it's literally maxing out the Suez.
Exactly. We're talking about vessels that can carry roughly 1 million barrels of crude oil.
1 million barrels on one ship.
Yes. They are massive, massive assets.
Okay, that definitely helps visualize the scale. Now, looking at the data, the detail that really stands out to me is their charter strategy.
Yes, the split.
Right, because they reported having about 59% of their fleet calendar days dedicated to time charters.
Right.
And about 39% exposed to the spot market. So let me test an analogy here.
Go for it.
This feels a lot like a real estate portfolio. A time charter is like renting out an apartment on a stable 12-month lease.
Exactly.
You know your monthly income, it pays the mortgage, it's safe,
predictable revenue.
Yeah. The spot market, on the other hand, is like keeping a few properties listed as daily Airbnbs.
Oh, that's a great way to put it.
Right. You have no guaranteed income tomorrow, but if a massive convention comes to town, you can instantly charge surge pricing.
That analogy tracks perfectly with their capital allocation. The time charters provide the revenue visibility and, downside protection.
That safety net.
Exactly. While the spot market provides pure upside exposure.
Right. But looking at their specific breakdown, I kind of want to piece this together. They chose to keep exactly 6 of their product tankers and both of those massive Suezmax crude tankers in the volatile spot market.
Right, acting like the daily Airbnbs.
Yeah. While keeping the vast majority of their dry bulk carriers locked up on those safe long-term time charters. So why isolate the risk just to the tankers?
Well, it comes down to their underlying financial architecture, specifically their break-even costs.
Okay.
The Q1 reports show that Imperial Petroleum has remarkably low daily cash flow break-evens. For the tankers, it costs them about $8,500 a day to operate.
Okay.
And for their dry bulk vessels, it's roughly $6,500 a day.
Meaning they need like very little daily revenue just to keep the engines running and the crew paid.
Precisely. Because those baseline expenses are so low, the steady, predictable income from the dry bulk time charters is more than enough to cover the company's core operational costs.
Oh, so the dry bulk covers the baseline.
Exactly. That establishes a financial safety net. And once that floor is built, management has the freedom to take their tankers and place them directly into the spot market.
Because if the spot market crashes, they don't go bankrupt.
Right. They strategically expose those specific assets to market volatility because they had the structural padding to survive a downturn. And more importantly, to capture a massive upswing.
Which brings us perfectly to the catalyst of this entire deep dive.
Yeah.
Because setting up your biggest ships in the spot market is only brilliant if the daily rates actually surge.
Right. Otherwise, your Airbnb just sits empty.
Exactly. So what caused tanker spot rates to absolutely explode in early 2026?
Well, to map that out, we really have to look at the geopolitical landscape of late February 2026.
Okay, and before we do, I want to take a brief pause and speak directly to you listening.
Yeah, this is important.
The sources we are analyzing detail the financial impacts of the U.S.-Iran-Israel conflict that escalated in early 2026. Because this is a highly charged and sensitive geopolitical event, we want to be absolutely clear.
Very clear.
We are not taking any political sides, nor are we endorsing any viewpoints regarding the conflict itself. Our strictly impartial mission today is just to report on how the source documents describe these specific events affecting global trade routes and corporate balance sheets.
That context is vital. So according to the Imperial Petroleum reports, the outbreak of this conflict resulted in a severe compromise of a major global choke point,
Right.
the blockage of the Strait of Hormuz. And when that transit lane was cut off, the immediate consequence was that about 10% of the compliant tanker fleet was suddenly stranded inside the Middle East Gulf.
Okay, let's clarify a term there. What exactly does the quote-unquote compliant tanker fleet mean in this context?
Right, good question. So the compliant fleet refers to vessels that operate fully within the bounds of international law and transparency.
Meaning they follow the rules.
Exactly. They carry proper insurance, they adhere to environmental regulations, and they abide by global sanctions.
As opposed to what?
As opposed to the quote-unquote shadow or dark fleet,
Oh, right.
which consists of older, often uninsured vessels operating completely off the grid, specifically to move sanctioned oil.
Okay, got it.
So when the sources say 10% of the compliant fleet was stranded, they mean a massive chunk of the world's legal, fully operational shipping capacity was essentially removed from the board overnight.
Okay, wait. I need to push back on the mechanics of this because honestly, it sounds completely counterintuitive.
How so?
Well, if the Strait of Hormuz is blocked, oil cannot physically flow out of the Middle East Gulf.
Correct.
And if 10% of the fleet is trapped inside, completely unable to move cargo, how does an inability to actually transport oil equate to the second best profit quarter in Imperial Petroleum's history?
Right.
I mean, if the product isn't moving, nobody should be making money.
What's fascinating here is the underlying economics of a global supply shock. You really have to separate the localized disruption from the global demand curve.
Okay, walk me through it.
The demand for energy in Asia didn't suddenly vanish just because the Strait of Hormuz closed. Those countries still desperately needed crude feedstock to run their refineries and power their economies.
Sure, the demand stays the same. But if the physical oil they normally buy is locked behind a blockade, who cares what the demand is? They just can't get it.
Right, they can't get it from the Middle East Gulf, so they have to buy it from somewhere else. The disruption forced Asian buyers to source their oil all the way from the Atlantic basin instead.
Oh, I see the geographic shift. Instead of a relatively short, straightforward voyage across the Indian Ocean,
Exactly.
these buyers are now forcing ships to sail from the Atlantic, completely around the world, to reach Asia.
That is the crucial pivot. In maritime logistics, distance equals time, and time equals constrained capacity.
Yeah.
If a single ship now takes 3 or 4 times as long to deliver a cargo of oil because of that massive detour, that vessel is tied up and unavailable to the rest of the market for months instead of weeks.
So you have a smaller overall pool of ships to begin with.
Because 10% are physically trapped in the Gulf.
Right. And the ships that are actually free are taking way longer to complete their jobs.
Yeah.
That essentially strangles the available supply of ships.
The math is brutal for the buyers, but it's incredibly lucrative for the ship owners. You have relentless demand for the specific service of long-haul shipping, combined with a drastically shrinking fleet of available vessels.
Wow.
So risk premiums spike, capacity vanishes, and the spot market goes vertical. To illustrate the extreme nature of this squeeze, the sources highlight that Suezmax tanker spot rates hit an astonishing $104,510 per day.
Wait, $104,000?
Every single day.
Oh my God. And remember, you said earlier, their break-even cost to operate those ships is only $8,500 a day.
Exactly.
Everything above that line is pure, unadulterated profit. I mean, it's no wonder their net income jumped 148%.
Right, the margins became astronomical.
And the situation got so dire for the global energy markets that the sources actually note the International Energy Agency, the IEA, had to intervene.
Yes, they did. The bottleneck was so severe that in early March, the IEA took the strategic step of releasing 400 million barrels of oil and refined products.
Just to flood the market.
Exactly. The goal of drawing down those strategic reserves was to inject immediate supply into the market, attempting to calm the panic and alleviate the massive shortages caused by the inability to efficiently move oil on the water.
So that geopolitical shockwave perfectly explains the massive windfall for their tanker fleet. But, as we established earlier, Imperial doesn't just move oil.
Right, they have a mixed fleet.
Yeah, they have a significant fleet of dry bulk carriers shipping raw solid commodities. Did those ships just, maintain the status quo while the tankers brought in the fortune?
Actually, no. The disruption bled into the dry commodities market as well. The sources indicate their dry bulk fleet saw firming rates and a remarkably high operational utilization of 89.5%.
Okay, but why is that notable?
This is particularly significant because Q1 is traditionally a sluggish period for dry bulk. It coincides with the Chinese New Year, which usually causes industrial activity and shipping demand to dip.
Oh, but it didn't.
It didn't.
Here's where it gets really interesting. Because if you look at the global energy market, it behaves almost like a macroscopic game of whack-a-mole.
Oh, that's true.
Right. You block the oil and liquefied natural gas from flowing out of the Middle East, but those massive Asian economies still require baseload power. So if the oil and gas mole is whacked down, where does the energy demand pop up?
It immediately pops up in coal.
Right.
The documents outline a direct, fascinating correlation here. Because Asian nations lost access to their standard Middle East energy cargoes, they actively boosted their coal-fired power generation.
You just switched fuels.
It was a required immediate energy substitution just to keep the lights on and the factories running.
And the logistical reality is that you cannot put solid coal into a liquid oil tanker.
No, you definitely cannot.
To move coal, you need dry bulk ships.
Yeah.
So the blockade on oil inadvertently created a massive surge in demand for dry bulk transport.
Exactly. That pivot caused a significant rebound in the global coal trade. But the ripple effect didn't even stop there.
Really? Where else did it hit?
Well, the disruption forced the entire global trade network to rebalance, stimulating increases across various unconnected commodities.
Like what?
The data shows that iron ore departures to China rose by 4% year over year.
Okay.
Guinean bauxite, which is critical for aluminum production, jumped by 18%. Even the global wheat trade surged by 18%, supported by elevated prices worldwide.
Wow, even wheat.
Yeah. If we connect this to the bigger picture, it demonstrates the profound interconnectivity of global supply chains.
Everything is linked.
Completely. An isolated geopolitical event in a single strait doesn't just affect the specific liquid exported from that region. It redraws the entire global logistics map, forces massive energy substitutions, and creates urgent, unexpected demand in completely different shipping sectors.
And Imperial Petroleum, by having a deliberately mixed fleet of both liquid tankers and solid dry bulk vessels, was basically positioned perfectly.
They really were.
They captured the primary explosion in the tanker spot market, and then they rode the secondary wave of energy substitution in the dry bulk market.
It's a brilliant navigation of chaos.
It is, but it forces us to look forward. Let's imagine a scenario where there is a ceasefire tomorrow.
Yeah.
The Strait of Hormuz completely reopens, and those trapped ships are allowed to sail free. Does Imperial's profit engine instantly collapse? Like, are they just riding a temporary wave of chaos?
Well, that is the core question for any investor looking at this sector right now. But a review of their balance sheet reveals what essentially amounts to structural armor.
Structural armor.
Yes. They are heavily insulated from a sudden market correction.
What does that armor look like in the actual data?
The most glaring detail is that they hold zero bank debt. Zero bank debt. Their total liabilities equal a mere 8% of their total assets. Furthermore, they are sitting on a massive cash reserve of approximately $221 million.
Okay, I want to pause on the zero bank debt point.
Okay.
Because for a lot of businesses, being debt-free is, a nice goal. But in the shipping industry, isn't that practically unheard of?
It is exceptionally rare. Shipping is fundamentally a highly capital-intensive industry. I mean, a single new vessel can cost tens of millions of dollars.
Right.
So to build or acquire a fleet, companies traditionally rely on heavy leverage, borrowing massive sums of money from banks.
That makes sense.
But the fact that Imperial Petroleum is operating 21 large-scale vessels with zero bank debt means they have virtually no mandatory debt service dragging down their cash flow.
Oh. So even if daily spot rates plummet back down to earth, their $8,500 break-even is so low because they aren't paying off massive bank loans every single month.
Exactly. They aren't just surviving the cycles. They're flush with cash. The sources even note they are actively buying back their own stock.
Really? How much?
Well, up to May 21st, 2026, they repurchased over 850,000 common shares for roughly $3.8 million.
Wow. And management doesn't do that unless they see a deep fundamental strength in their own position.
Exactly. The balance sheet is a fortress. But beyond their internal financials, the sources reveal a structural advantage hidden in the broader market fundamentals.
Okay.
And this suggests that even with a geopolitical resolution, elevated shipping rates might actually be here to stay.
Wait, really? So even if the immediate crisis ends, there is something fundamentally broken in the broader supply chain keeping their moat intact. What is the structural advantage?
It is the rapidly advancing age of the global fleet. The documents highlight a really critical metric here. A massive portion of the world's shipping capacity is aging out of service.
Just getting too old to sail.
Yes. Currently, 16.3% of all Suezmax vessels worldwide are over 20 years old.
Okay.
For MR medium-range product tankers, 19.4% are over 20 years old. And looking at the dry bulk fleet, 15.8% have crossed that two-decade mark.
And for anyone outside the maritime industry, a 20-year-old ship is essentially a senior citizen.
Pretty much, yeah.
The salt water, the structural fatigue,
Yeah.
they become incredibly expensive to maintain, harder to insure, and way less fuel efficient. They're inevitably headed for the scrapyard.
Exactly. They have a finite operational lifespan. But the second half of that equation is the order book.
The order book.
Yeah, the volume of new ships currently under construction at shipyards globally to replace them. The sources state that new building orders are at historic lows.
Oh, wow. Which, that makes sense mechanically. You can't just order a massive oil tanker on Amazon Prime.
No, definitely not.
It takes years of lead time, massive capital investment, and shipyards only have so much physical capacity to begin with.
Right. The replacement cycle is fundamentally lagging. Even if a ceasefire occurs and Middle East producers return to pre-conflict output levels, and perhaps nations like Iran re-enter the global market, the world will still desperately need ships to move that cargo and rebuild depleted global inventories.
But the pipeline of ships is shrinking right when it needs to be expanding.
Exactly. The data points to a baked-in supply shortage. Older vessels are retiring, and there simply isn't sufficient new capacity coming out of the shipyards to replace them.
Wow.
This structural supply imbalance is projected to support high market rates for the foreseeable future, completely regardless of temporary geopolitical relief.
So what does this all mean? When we started, we talked about the invisible ballet of logistics that delivers the goods to your house. What this deep dive reveals is that your personal resilience to global volatility is directly tied to this exact data. It means the Q1 windfall for Imperial Petroleum wasn't just a lucky break. It's a symptom of a much larger systemic bottleneck. So just to recap our journey today,
Mm.
we watched how one company utilized the rare advantage of zero bank debt, an agile mixed fleet, and highly strategic spot market exposure
Very strategic.
to turn a closed strait into a staggering $28 million in net income in just 3 months. They proved that in the cold calculus of global logistics, chaos isn't just a disruption, it's a multiplier.
This raises an important question, though.
Okay?
We've spent our time analyzing the mechanics of corporate strategy and one company's ability to capture value. But if we pull back and look at the macro horizon, with nearly 20% of global shipping vessels quietly aging out of commission and historically low new orders to replace them, are we quietly entering a permanent era of high shipping costs?
That's a huge thought.
Because if the physical infrastructure of global trade is fundamentally shrinking, that invisible bottleneck is going to impact the baseline price of almost every physical good you purchase over the next decade.
It really changes how you look at the price tag on everything. The invisible plumbing of the world is getting fundamentally more expensive. Thank you for joining us on this deep dive. Keep questioning the hidden mechanics behind the headlines, and we'll see you next time.